The other day, I was down at the local boucherie doing my usual staring at watches that I cannot afford day. While I was there, another customer walks in and says, I want to look at a watch that I can invest in and make some money. I don't want to make a return straight away, but I want a secure investment. Can you point me to the watches that are best for this? You know, Rolex and those kinds of watches? It's not hard to find sites that are doing their best to convince you to invest in watches. To be clear, you can buy watches today that will be worth more tomorrow. There is no disputing that. Also, there is nothing wrong about caring whether or not your watch will hold some or all of its value. That's not what I'm talking about though. I'm talking about investing in watches, grifters, and snake oil. This all worries me, and that's why I thought I would put together this video where I will go through my 8 major concerns regarding investing in watches. I read on a watch investment site that watch investing was to make money, to have a portable asset, to celebrate a milestone, to invest in your style, and to leave a legacy.
No, God, please, no, no!
I barely know where to start in describing my internal emotional reaction to this chain of dialogue on the website. I mean, I get it. People want to make money, and there is a belief that watches are a great investment, despite the recent crash that we've seen since early 2022 in the watch market. To start off with, before we even get to watches, it's necessary to lay a foundation for what investing really is, irrespective of watches, get some concepts well defined so we know what we're dealing with. The easy part, return on investment. Easy enough. For whatever initial amount of capital, i.e. cash, you put down, your return is the value of the potential capital you have at a later date in time. Now the harder part. What's a good investment? When you boil it down, it comes down to a combination of several factors: relativity, time, risk, and risk mitigation. What would my capital have been worth if I had done something else? As a baseline, you would ideally like your capital to grow at a rate higher than inflation. That's hard these days, but that's ideally your bare minimum in a growth economy. From there, it gets significantly more complicated. It gets complicated because whatever you want to spend your money on will depend on when you spend it and when you want to cash in. Take a look at this NASDAQ NDX. If you invested in a portfolio of primarily NDX type shares in November 21 and you wanted to cash in now, you've lost a bucket load of money. But look at the exact same index since 2013. That's several 100% in growth. Same index, different conclusion. The difference is time. If you bought a Daytona here, you've lost money so far. If you bought it here, you're still coming out ahead. Apple has been a better investment than GE over the last 10 years, but over the last 1 year, GE has been better than Apple. The point is this: what you bought and when you bought is important. When you intend to sell is also important. Time and time frame is an important component of evaluating an investment. Then there's the risk component. As a general rule of thumb, high potential return equals high potential risk. They follow each other. If you look at companies that have been doing the same thing for decades, their stocks have slowly increased over time, but their performance is, on average, not stellar. It's a good, safe return. Compared to modern tech, the returns are nowhere near as good. But tech is more risky because tech is often predicated on an assumption of continued growth and expansion. Netflix is a good example. They took a huge dive about a year back because their market cap was based on an assumption that there was a huge untapped potential growth in subscriber base. The moment Netflix announced that they were stagnating and even losing subscribers, their stock tanked from its peak. The market had a baked-in future potential into its value that turned out was unrealistic. Risk is important to understand. How then do the Warren Buffetts of the world continue to do really well investing? Time and diversification. Time usually buffs out risk. So the longer you hold onto something, the lower the overall risk usually becomes. But conversely, so does the aggregate reward potential. Warren isn't in it for quick wins. He wants stable returns over time. Then you can diversify, which means don't put all your eggs in one basket. The Warren Buffetts of this world spread their capital among a huge and diverse portfolio, taking some high growth, high risk stocks and mixing in some more stable, less risky stocks. Warren Buffett loses money on individual assets every day, but over time his diversification keeps him insulated from the worst negative shocks of singular investments because they make up a relatively small portion of the total portfolio. To sum up, what makes a good investment is not just the potential return. You cannot just look at the expected return or recent historical performance and conclude based on that something is a good investment. To qualify the efficacy of an investment, you must understand its potential compared to alternatives, an assessment of associated risks and rewards, the time frame for the investment, and all of this needs to be evaluated in the context of your total investment portfolio. You have to do all those steps for each and every investment. This brings us to watches and the 8 challenges to investing in watches. Problem number 1, diversification. If you buy one watch, you are not diversified. If you have $1 million in stocks, a pension fund, and a house, you could theoretically consider that one watch as part of a diversified portfolio, but generally speaking, holding one watch or one asset class is not diversified. One gold bar is not an investment. It's at best a nest egg. The problem is that with one watch, your entire portfolio is predicated on the future potential of that one watch, which someone might steal, by the way. You have one very expensive egg in that flimsy basket. Depreciation, costs, and sales commissions. A watch is a physical object like a car, and in general, if you wear it, it will depreciate in value. Let's ignore for the moment the total tanking of the grey market for watches over the last year. The line for the Daytona is still above the MSRP, but you have to remember a couple of things. The Netflix stock is worth precisely what it says on the line on the day you sell it. That isn't the case for the Daytona. The Daytona line is based on expected resale of a new, mint condition, unused box and papers model. If you've worn it, it will be worth less. Additionally, depending on how long you've owned it before selling it, you will have to invest in servicing the watch to ensure that it functions as new. You have to factor that into the total investment cost. Also, if you choose to leave it in a safe at the bank, you have to factor that cost and insurance costs as well. Also, that line represents what people are willing to pay for a 2022 watch in 2022, more so than a 2016 watch in 2022. The effect of time on the watch's value is unclear. You cannot by default assume that all watches, no matter their purchase date, will be sold for that precise number on the curve. Then there's also the issue that if you're not comfortable with selling that watch directly and taking on all the associated risk, you have to find a reseller, and for that person to make a profit through commission, and they will have to offer you a lower price than the line you see on the graph. Time limit and quality. Watches are just really well made today, and you have a time limit before your return starts going down. Not necessarily negative, but the maximum potential will go down. I've spoken quite a bit about the time aspect of investing, and with vintage watches, you see historical models being sold for extreme sums of money. But what you have to remember is that they're being sold because these watches also have some unique characteristics. It's a watch that has a degraded dial that's called a tropical. Or it's a Comex Rolex that has a very specific provenance and a very limited production run. Or it's the movement used prior to the moon landing. I honestly don't believe new watches are going to degrade positively in the same way. That 116500 ceramic is going to potentially look exactly the same in 25 years because it's made so well. I think a lot of new watches aren't going to develop those idiosyncrasies that command a collector's premium over time. To me, this indicates that many of these new in-box investments are best the shorter the time you hold onto them. How short? Well, it depends. For the most part, modern watches will need to be sold as quickly as possible to get maximum return and minimal depreciation. Your investment is fundamentally time limited. Not all watches are going to turn into fine wines over time. Rather, it's sell fast or lose out. Transparency in resale value. If you go to Theo and Harris, John P, and some of the others in the watch community, they will tell you that the price something is listed as on many sites is not the price it's sold at. You can see the same on watch charts. This can go in both directions, but you cannot by default assume that a price on Chrono 24 is always the going secondary sale price for any watch. Netflix's stock price is essentially that price, but the Daytona watch chart is an aggregate with a range and a standard deviation up and down from that point. What that deviation is will vary from watch to watch due to multiple factors and a negotiation every time over the specific watch, making an evaluation of the investment difficult. Emotion or hype. I went down to the AD to talk about getting a Pelagos. Sold out. Waiting list. I was in France. I wanted a Moons watch. Sold out. Not available. I wanted a PlayStation 5 during COVID. I could get it at 2 or 3 times MSRP. They were all hyped out and people were still willing to pay a premium. That did not make them a good investment. The PS5 has not appreciated in value, and neither will the Moose watch or the Pelagos. Even though we're on the tail end of the watch investment Klondike, hype still makes it hard for a regular person to figure out what is actually a true investment piece and what is just hyped at the moment. There is so much emotion attached to all of this that rational judgments get clouded. Access. There's no getting around it. A vast majority of watches still do not hold their value over time. The watches that do hold or gain in value are fundamentally still few and far between. Rolex models almost universally hold their value, and many even appreciate in value over time. But outside of Rolex, I can't think of a brand where a majority of their models hold their value. It's not AP, think of the Millenary, not Patek, it's not Lange, it's not Omega. The waiting list is 5 years, if that, for a Daytona. If you want to invest in that specific model, realistically, you either have to factor in buying other watches that will lose value to build the purchase history at an AD, or buy it at the top of the secondary market at well above MSRP. Either way, your overall investment starts off worse. You've immediately bought one very expensive egg at the current height of the market, hoping that it will continue to go up. It may go up, but it's still just one egg. Well, actually, it's not just one egg. It's a very specific egg from a very specific hen laid at a very specific time. If you can't get that specific egg, then you're out of luck. Transparency and math. Most of us aren't day traders. We don't have years and years of data and experience in interpreting market and financial data of a company. I have a friend that actually makes a living day trading, and it's a full-time job for him. He pulls a year-on-year return of around 5 or 6% over the last 8 years. It was higher, but this last year has brought him down to 6%, which is still very good. The amount of effort he puts into understanding the market and the individual investment far exceeds what many of us do. The emotion attached to the watch market leads me to believe that a lot of people are putting far too little effort into understanding the investment, and some actors are capitalizing on that. We are not actually doing the math, don't have the transparency, and that is inherently risky. Price. One watch is $11,000. You can get 75 Apple stocks for that price. That's an expensive egg. With those 8 concerns, I'm reminded of Homer Simpson.
This year I invested in pumpkins. They've been going up the whole month of October. And I got a feeling they're going to peak right around January.
With watches, it's worse. Like I said, with watches, you have to know specifically which hens are not just hype hens. Then know which ones will lay the specific right eggs. That one egg is super expensive and you carry the risk of it being damaged, lost, or stolen. Then you have to get special access to get the actual specific egg at the specific right time. You have to baby those eggs so they don't lose value. And then you can maybe sell it at the price you think it's worth down the line, preferably before it goes bad. I love watches. I love looking at them, nerding out about them, and wearing them. Yes, I can get frustrated how investors limit access to watches that would otherwise be worn. But whatever, that can't be stopped. Having said that, for us, the average Joes, I think we are being hoodwinked by grifters and snake oil salesmen. Like I said, I read on a watch site that investing was to make money, to have a portable asset, to celebrate a milestone, to invest in your style, to leave a legacy. Run for the hills. Bullets 2, 3, 4, and 5 have zero to do with investing and have no bearing on whether something is a good investment or not. It's appealing to emotion, not sound financial advice. It's appealing to the thrill, the gambling element, not thorough, measured advice. It has nothing to do with investing and everything to do with getting your money out of your pocket. You simply must not be swayed into investing based on anything other than the potential return and the detailed data substantiating historical performance of that investment class in regards to delivering relative return, the risk of the asset class over the investment timeframe in the context of your total investment portfolio. Anyone saying you should invest because it's fun or appeals to your emotions should be ignored thoroughly. Anyone appealing to you saying, well, it's outperforming the market, is only showing you one part of the total equation. Could you make money off of selling a watch? Of course. I have sold a watch that I sold for more than I bought it at. It had a good return, but it wasn't a good investment. Don't fall prey to the grifters. And also, buy a watch because you're going to wear it. That's their purpose. That's all I have to say. Thanks so much for listening, and I hope you found this useful. And, come back another time. Enjoy your watch. Leave your comments below. See you out there. Cheers.